Hello and welcome to Ticker Tapes. It's Monday, so that means FANGs are on the agenda again. It's been another tough week for several of the FANG stocks. Amazon was the biggest loser, falling by 7.1%. Much of that damage can be laid at the door of FedEx, which recently issued a profits warning. FedEx pulled its 2023 guidance, saying that its first quarter results were adversely impacted by the global volume softness that had accelerated in the final weeks of the quarter, and that FedEx Express results were particularly impacted by macroeconomic weakness in Asia and service challenges in Europe. FedEx stock fell 23% on that news. So why does what happens at FedEx matter to Amazon investors? Quite simply, the volume of business at FedEx is a proxy for consumer demand and e-commerce fulfillment. And if its volumes are falling, that may indicate that retailers are shipping less and that consumer demand is tailing off. FedEx didn't specifically mention the U.S. market, which is Amazon's largest, but the news spooked traders, coming as it does, just 2 months ahead of Black Friday and the crucial holiday shopping season. Amazon is now down by almost 30% year to date. Apple stock trod water over the last week, up by just 0.24%. The launch of the iPhone 14 was broadly seen as a success, although some users have reported issues with the phone's camera, and Apple is said to be working on a fix. It's also been revealed that the new devices contain a satellite modem manufactured by Qualcomm, which allows users to connect to satellite networks, enabling them to send emergency messages if there is no Wi-Fi or cellular coverage. Apple has become the main sponsor for the Super Bowl's halftime show, taking over from PepsiCo. Apple has signed a deal said to be worth almost $50 million to assume sponsorship of a key segment in one of America's most widely watched sporting events, which last year drew in an audience of some 112 million viewers across TV and video streaming channels. Netflix stock continues to recover, bucking the trend in the wider market. Over the last month, the video streaming giant has rallied by 4.64%. However, over the last quarter, it's up by a whopping 32.5%. Investors and traders are reevaluating the company's potential and the changes it has made to both its business model and cost base. Analysts at Wolfe Research wrote this week that the stock should now be judged on a more balanced set of KPIs, or key performance indicators, moving away from the very narrow focus on subscriber numbers that have previously been the driver of sentiment and price performance in the stock. Citi analysts recently raised their price target on Netflix to $305 from $275 and reiterated their buy rating on the shares, saying that Netflix has more opportunities to improve its free cash flow relative to major rivals such as Disney.